Getting into investing can feel, well, super overwhelming. But what if I told you the biggest risk you can take isn't picking the wrong stock, but doing nothing at all? So, over the next 5 minutes, we're going to break down exactly how you can start building long-term wealth simply and effectively.
All right, let's jump in. Here's our game plan. First, we'll talk about why you absolutely have to invest. Then we'll cover the basic tools you need. After that, we'll go through the golden rules for growth, how to sidestep those common beginner mistakes, and we'll wrap it all up with a clear, actionable first step you can take today.
So first up, let's just bust the biggest myth in personal finance right now, this idea that your money is safe just sitting in a bank account. Because as we're about to see, keeping your money safe is actually a guaranteed way to lose it.
So you really got to ask yourself that question. I mean, sure, it's safe from someone physically stealing it, but it's totally exposed to something much sneakier. Something that's chipping away at its real value every single day.
And that threat? It's inflation. It's basically this silent tax that makes everything more expensive over time. So that cash you saved up, it just buys you less and less stuff year after year.
And while this chart right here just shows you the damage perfectly, check this out. 100,000 pounds today, assuming a pretty normal 2% inflation rate, will only have the buying power of about 45 grand in 40 years. That's insane. You've lost more than half your money's value just by doing nothing. Right? So here's the big takeaway. Holding cash isn't just playing it safe. It's actually a choice you're making. And it's a choice that guarantees you'll lose purchasing power down the road. So investing isn't really about getting rich quick. It's a defensive move. It's about protecting the future you from getting poorer.
Okay, so if cash is the loser, what's the alternative? Let's talk about the tools you'll need. The good news is, to fight back against inflation and actually grow your money, you only need to get your head around a couple of basic building blocks.
First up, you've got stocks. When you buy a stock, you're not just buying some code on a screen. You're literally buying a tiny little piece of a real business. Think Apple or Amazon or whatever. And if that company does well, hey, so does the value of your little piece.
All right, then you have bonds. Now think of a bond as just an IOU. You're basically loaning money to a government or a big company. And in return, they promise to pay you back with interest. They're not as exciting as stocks, for sure, but they're also way less of a roller coaster. They add some stability to the mix.
Okay, but here's the classic beginner problem, right? How on earth are you supposed to pick the winning companies out of the thousands that are out there? It's super hard, it takes a ton of time, and honestly, putting all your eggs in one basket is just really, really risky.
This is where the modern solution comes in for, well, most of us. The Exchange-Traded Fund, or ETF. The best way to think about an ETF is like a pre-made basket of investments. Instead of trying to find that one perfect apple, you just buy the whole fruit basket at once. So with one click, you get instant diversification, which spreads out your risk all in a single, simple trade.
All right, so we've got our tools, ETFs. Now let's talk about the golden rules. These are the core principles that really separate successful investors from, well, everyone else. Rule number 1, and this is by far the most important. Your greatest superpower in investing isn't how smart you are at picking stocks. It's time. It's all because of this incredible, almost magical force called compound growth, where your money starts making money for you. Let me show you what I mean. Okay, say you start investing 5,000 pounds a year when you're 35. By the time you're 65, you could have around 354,000 pounds. That's pretty great, right? But hold on. Watch what happens if you had started just 10 years earlier, at age 25. That same 5,000 a year, it turns into almost 640,000 pounds. That's nearly double the money. That extra decade alone is worth almost 300 grand. Time, it's everything. Okay, golden rule number 2. You have to accept that markets go up and down. It's just what they do. That volatility, those swings, they aren't a sign that something's wrong. Think of it as the price you pay to get those better long-term returns. So just expect it. Don't freak out.
And this chart, it shows you just how normal those scary-looking drops really are. See those red dots? That's the biggest dip the market took at some point during that year. Looks pretty scary, right? But now look at the gray bars. In most of those exact same years, the market still ended up positive. The whole secret is just staying in your seat through the turbulence.
And that brings us perfectly to our next point, because all the data shows that the biggest obstacle to your success isn't the stock market. It's you. It's our own emotions. This chart just lays it all out. So that line is the market going up and down. The bars show when people are selling and pulling their money out.
Do you see the pattern here? We humans, we tend to panic and sell in massive numbers after the market has already tanked. We sell at the bottom, locking in our losses just before things start to get better. It's classic panic selling. So look, to succeed, you just have to avoid these classic traps. Don't panic sell when things look bad. Don't chase some hot stock because you've got FOMO. Please, don't try to guess when the market's going to go up or down. Nobody can do that consistently. Oh, and a big one. Make sure you actually invest the money you put in your account. Don't just let it sit there as cash. And finally, keep an eye on fees because they can eat away at your returns over time.
Okay, we've covered why you need to invest, what to invest in, and what traps to avoid. So let's bring it all home with a super simple step-by-step plan to get you started today.
Just think of this as your financial checklist, the order of operations. Step 1. If your job offers a pension or retirement match, you have to contribute enough to get the full match. It is literally a 100% return on your money. It's free money. Take it. Step 2. Get rid of any high-interest debt. I'm talking credit cards, personal loans, anything over, say, 7 or 8%. Paying off a 20% interest credit card is like earning a 20% return on your money, completely risk-free. It's a no-brainer. And then, once you've done those two things, step 3 is to set up automatic contributions into a simple, low-cost, globally diversified ETF. You just set it and forget it.
And just remember, this whole thing is not a race. It's not about getting rich quick. Building real, lasting wealth is a marathon. It's all about being slow and steady, disciplined and consistent over a long, long time. It has nothing to do with finding the next crypto moonshot overnight.
Look, we've seen it with our own eyes. Time is your most powerful tool, which means the cost of waiting, of doing nothing, is the one thing you can never, ever earn back. So I'll leave you with this question. What is your next dollar, your next pound going to do for the future you, the person you'll be in 10, 20, or 30 years from now?